Now, where we go. So what we're looking at today is employee benefits. And yes, this topic isn't in the mid-semester exam. However, there are aspects of it which are really useful for the mid-semester exam, being the fact that we're still covering some of the same stuff you looked at last week in provisions and liabilities. So some of the same ideas around the framework and the definition of liabilities, some of the same ideas crop up here as they did last week. So to the extent that it's not a complete waste of time for the mid-semester, is still important. There's some interesting things going on, and there's some really topical things going on in this area. So, we'll have a look at those as we get to them. Now, 3 areas. We're going to look at the framework definition of a liability. We're going to look at why the accounting for employee benefits is problematic. Now, in a nutshell, if all we did was just get paid basic wages in terms of, we work and we get paid cash into our bank accounts or cash in brown paper envelopes, we could pretty much walk away after 5 seconds here. You just go debit, wages, expense, credit, cash. That's how you account for it. But that's not the case. We've got a whole range of other benefits that we could potentially get, and those are things which are potentially problematic for the accounting. And one of them especially, which is getting a lot of interest at the moment, is superannuation and specifically defined benefit plan accounting. And it's not just small beer either, there's actually quite large sums involved. Then just looking at the regulation around them. This has stopped working again. Right, yeah. What's happened here? Zoom it. Okay. Technology's gone a bit nutty. So, definition of a liability. A liability, as you should well be aware, it's only 8 days out, has 3 parts to it, and it's almost a mirror image of the definition of an asset. Now, the really neat thing about having a framework is, and Rob has probably talked about this at length, but the neat thing about having a framework is it gives you hopefully a fairly consistent basis to deal with the accounting, which is why last week's topic wasn't that big a one, but it was a really important one. Because pretty much most of the things that we're going to cover, so whether it be contingents from provisions from last week, whether it be employee benefits this week, when we start looking at some financial instruments in weeks to come, leases, there's a lot of liabilities involved in that, and the same idea flows through most of those things. So we're looking at a situation where there has to be some sort of current or present obligation of the entity. So at this point in time, you have to basically be on the hook for something. It can't be that you expect to do something in the future, so there has to be a past event from this. You can't be, I expect to go off and buy something in the future and I'm obligated for that. It has to have happened and you have to be currently obligated for it. And in addition, there's got to be some sort of outflow of resources. So you've got to be able to make good, and that is actually going to cost you something. It's going to be something which leads to a reduction in your, in essence, economic benefits. So the definition of liability, so in terms of the obligation, I'm an employee of this university. So I've got an obligation, I've got a duty to act in a certain way and to do certain things. And that's be here and talk to you guys. Hopefully on a Friday evening, not send too many of you to sleep, which is probably maybe a struggle just for me, not because, well, hopefully I'm not going to send myself to sleep, because if I'm going to do that, it's probably a struggle to keep you guys awake. But jet lag is something that's still sort of kicking on. Yesterday I was falling asleep at about 7 o'clock, so hopefully I can sort of push out a little bit further today. But the university has an obligation to me as well, as we have a contractual relationship, is that I perform the service and they pay me. So as long as they're paying me, they're satisfying their end of the bargain. Past event. The transaction must already have occurred. Now this becomes important for employee benefits, and I'll analogize to some of the things I saw over in Europe in a second. But I can't expect to do something. So, I come back home. I came back home on Tuesday, and I normally cycle to work, and my bike got stolen quite badly, and it's I mean, it was a pretty cheap bike to begin with, but pretty much it's a write-off now. I'm going to have to buy a new one. My intention to buy a new bike, that's not a past event yet. So even though I fully intend to go off and buy one, I do not have a liability in relation to that bike because I haven't bought anything. There is no past event related to it. How it relates to employee benefits is actually much the same. You don't have a liability for an employee for the future work that they're going to do. Now, one of the things that seemed to catch my interest a bit over there, and Rob may have mentioned it, I'm quite interested in sports. Football is not something I'm all that interested in, but you go over to England and pretty much wall to wall on the newspapers and on the newspapers, on the telly, on the radio, EPL and football is just all they seem to talk about. And I mean, did anyone see, I think it was like 2 weeks ago or so, Gareth Bale's transfer from Tottenham to Real Madrid? Who's Gareth Bale? He transferred, I only heard of this bloke when I was over there, the highest transfer fee in the world. Real Madrid paid £85 million for him, and that's just the transfer, that's just to his old club. Plus, I think they're paying him something, it was like 25 or 30 million pounds a week to play. So it's, you're talking quite large sums of money. That will not come up as a liability on their books. And the interesting thing is, Manchester United is a publicly listed company on the NYSE. The Brisbane Broncos rugby league team in Australia is a publicly listed company on the ASX. So you can actually you could buy shares in the Brisbane Broncos. Given how they're doing it at the moment, you might not want to, but you can actually buy shares in them. But the one thing that you won't see in there is you will not see, even for players which have a 2 or 3 year contract, 5 year contract, you will not see a liability on their books for the future payments they're going to make to these players, because you only show up the services being provided, the service that those players have done, the work that they've done, you only show that up. And the last bit is there's got to be an outflow of resources, which is fairly straightforward. Now, even with all of that, you may not still have a liability to be able to be recognised on the financial statements. To be able to do that, it's got to be probable that there will be an outflow. And last week you looked at provisions and contingents and looked at how the sort of probability becomes important as to whether or not it's a probable outflow. If it isn't, then you're likely to have a contingent liability. Reliability also is an issue that we need to consider. That's all sort of going through the stuff from last week, this week. So why is it problematic? Wages and salaries, that's obviously a big component of it. You guys are working, that's obviously a pretty important component because that's what we get paid on a weekly or a fortnightly or a monthly basis. But depending on the type of work that you do, and depending on whether it's casual, whether it's part-time, full-time, cash in hand, who knows, some or all of these conditions you may have access to. So for me, as a university employee, I get sick leave, I do get annual leave, I don't get any bonuses. You kind of wonder how some of the bonuses could work. Maybe we could get a bonus based on our failure rates, but if we did that, you can kind of imagine how many people would pass. I'd probably imagine everyone, unless it worked in the reverse and we failed and we got bonuses on being tough. But either way, that type of bonus system wouldn't work. Share options, performance rights. Okay, again, we can't buy shares in this university. I mean, I don't think you can buy shares in pretty much most universities, so that's not an issue. I do get long service leave. I just went on a sabbatical. I do have superannuation. Hopefully I'm never going to have to worry about this one. Termination payment isn't just getting sort of the leaves that you had accruing and taking away when you leave. Termination is actually like, here's a redundancy package, we want you to go sort of thing. And again, hopefully I'm not going to have to worry about that, but I'm assuming those sort of things do happen at universities. But it's having all of these things which become quite complex. So long service leave. Here, and the things I know how long it is because I've just actually triggered my long service leave. We need to be here for 10 years to get our long service leave. So now I've actually got it. But how do you account for that before someone gets to 10 years? Because do you just leave it all as an expense? And this is just sort of something to think about, and we'll have a look at how it works, but just for you guys to think about at the moment. So for 10 years, so I've been working diligently, I hope, but I've been working for 10 years. From the university's point of view, do you think it makes sense that, say I decided to take all my long service leave at the end of this semester, do you think they should recognise the entire amount of that expense, so 10 weeks of, I don't know actually how much leave I get, all of that expense in that one period when I just decide to take it? Or should they recognise it all at the start, which that's probably a pretty silly one. Or do you think they should try to figure out some way to measure it as you're going over time? But if you're trying to do it as you're going over time, how would you measure that? Like, how would you come up with that number? That's quite a tricky thing to think about. And if you think that's tricky to think about, that's only looking at a 10 or 12 year situation.